Rate cuts or no rate cuts, Indian yields have been steady. And now with election results coming up, all eyes are on what the bond markets are going to be doing. That's what we'll be discussing in our Debt Outlook session for today. And I have with me Deepak Agarwal, the Chief Investment Officer for Debt with Kotak Mahindra Asset Management Company Limited. Hi Deepak, thank you so much for joining us. Before we get into the Indian bond market, let's talk about what has happened in the US, because we have seen positive macroeconomic data coming in over there. Now, while that should be good news, it's actually not that great news, because it means that the US Fed will not be cutting rates anytime soon, right? What's your reading on this?
See, if you look at the recent US data or the data from Jan till date, the growth has been slightly strong. So if you look at the jobs data, the retail sales data, they are painting a good picture about US economy. At the same time, inflation has been in the band of 3 to 3.5% in US from Jan till date. At the start of the year, basically markets were pricing in close to 150 basis point rate cut during this calendar year, with the first rate cut as early as March 2024. Now, post this strong data and relatively inflation being in the band of 3 to 3.5%, market is now pricing in close to 40 basis point rate cuts, with the first rate cut either been in September or November 2024. We had the Fed policy last month, and the Fed commentary was relatively dovish as compared to market expectation. Fed is looking at this data slightly differently. According to Fed, the pace of activity has slowed down as compared to last year. And yes, the pace of decline of inflation has also receded in recent past. So according to us, Fed through its commentary, wants to actually aid a soft landing or a no landing in US, and wants to ensure that probably there is no hard landing in US. And Fed believes that the current monetary policy stance of keeping rates higher for some more time may be an appropriate stance to be maintained. We continue to expect 100 basis point rate cut in US from now till December 2025.
Now, back home, the RBI has declared a 2 lakh crore rupee dividend to be given to the Indian government. That's a big windfall of sorts. What sort of fiscal room will this make for the Indian government?
See, again, this dividend number was huge, and it was a positive surprise for the market. Government of India or market's expectation was between 1 lakh to 1,50,000 crore dividend from Reserve Bank of India. However, the actual number was way higher at 2,11,000 crore. Now, when government presented its budget in February 2024, they had projected close to 1,02,000 crore from three entities, basically Reserve Bank of India, banks and financial institutions. With this 2,11,000 crore, it's likely that the dividend from these three entities would be close to 2,25,000 to 2,50,000 crore. So government has got an additional surplus of 1,25,000 crore, which is 0.3 or 0.4% of GDP. Now government has two choices, either to increase its expenditure by that extent, or to reduce the fiscal deficit and thereby the market borrowing by that extent. We believe that probably when government presents its final budget in July 2024, it may use a combination of both, increase capital expenditure to some extent and reduce the fiscal deficit to some extent. Post this announcement, because it was a positive surprise, we have seen close to 5-7 basis point drop in bond yields across the yield curve. And in case in the final budget, if government decides to reduce the borrowing and not increase the capital expenditure, the probability is low, we can see further rally in bonds. Now that's with respect to bonds. Prior to this announcement, the core liquidity in the banking system was close to 1,40,000 crore. Due to this dividend, the core liquidity in the banking system has now risen to close to 3.5 lakh crore. So, as and when government starts spending this money over the course of, let's say, June and July, the short-term rates, which are slightly higher, can also trend lower over the course of next 1-2 months.
We have the election results on the 4th of June. What would you be watching out for in terms of factors that will affect the Indian bond market?
See, currently the market consensus seems to be that the current government will come back to power. However, the market opinion differs with respect to the number of seats. This government for last 10 years has managed inflation very well, and the fiscal deficit also has been kept in check. Yeah. So if the current government comes back to power, there will be expectation that the policies on the inflation front and fiscal front will see continuity in policy. So it will be a positive. So current government coming back to power along with index flows are starting from next month onwards. So these two factors can lead to additional 10-15 basis point rally in bond yields over the course of next 2-3 months. However, if the actual outcome is against market expectations, we could see sell-off across asset class, including equities. Bond prices will also fall and yields will rise, and we can also see some pressure on the currency.
What's your outlook on the way ahead for the Indian bond markets and the yield as well?
So let's say, let me divide that into long-term rates and short-term rates. So long-term rates from let's say mid-April, long-term rates have come down by close to 20 basis point. The factors which have resulted in drop in long-term bond yields were one, let's say we saw a drop in global bond yields. Second, dovish Fed commentary. Third, we had the huge dividend from Reserve Bank of India. Fourth, market expectation that the current government will come back to power. And the fifth, that we have index flow starting next month. So over next 2-3 months, we believe that global bond yields will remain in a range, index flows, and assuming current government coming back to power, we believe long-term yields can trend lower by 15-20 basis point over next 2-3 months. Short-term rates, because of tight liquidity, had inched up. Recently, Government of India decided to reduce it T-bill calendar or reduce the T-bill borrowing for this quarter, which has resulted in short-term rates trending lower. However, the rates up in the 1 year to 3 year category still continue to remain elevated. Now the core liquidity in the banking system has increased as and when government takes charge and starts spending that money and liquidity increases in the banking system, we also expect short-term rates to trend lower over the course of next 2 months.
And finally, how would you advise debt fund holders to position themselves currently?
Over the course of last 6-9 months, since we were of the view that the global hiking cycle is over and domestically also the hiking cycle is over, and the next action from domestic and global central banker is rate cuts. And plus the domestic macro story is also very strong. The fiscal deficit is under check and we have index flow starting next month. So we have been advising investors to increase duration of their portfolios. Now investors with 1 year plus investment horizon can either look at longer duration funds like dynamic categories or long duration fund or gilt funds, or investors can also look at 3 or 4 year duration funds which have higher allocation to corporate bonds resulting in higher portfolio YTMs. There the investors can look at categories such as medium term or banking PSU funds.
Thank you, Deepak, for that. Well, there you have it. That's the outlook for the Indian bond market. Do stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.